Picture two people in the same month, in the same economy, watching the same headlines. It is early 2020. The market is falling fast. People are posting charts, predictions, warnings. Everyone is talking about risk. Fear is everywhere, not just in finance, but in daily life. First, picture Daniel. He is 30 years old. He has a decent job and a decent income. He is not rich, but he is responsible. Over the last few years, he saved $20,000 in cash. It took discipline. He feels proud of it, and he should. He tells himself that cash equals safety. He also tells himself he will invest, but only when things calm down. He wants to do it the smart way. He wants to avoid mistakes. He wants certainty. Now picture Laura, similar age, similar income, similar intelligence. She is not a trader. She does not pretend she can predict the market. She just has a system. She keeps an emergency fund, and then she invests consistently. When prices drop, she does not freeze. She continues. When prices drop a lot, she increases her buying a little if her plan allows it. She does not do it because she loves risk. She does it because she understands a simple idea. The best discounts rarely arrive with a feeling of safety. 5 years later, Daniel still has most of that money in cash. The world did not become perfectly calm. Something is always happening. A new crisis, a new election, a new war, a new recession fear, a new inflation scare. Daniel keeps waiting for the moment when he finally feels confident. And because he is waiting, he is missing the one ingredient that quietly creates wealth for people who are not even trying to be brilliant. Time and productive assets. Laura is not lucky. She did not need secret information. She did not need a fancy job title. She did not need to guess the perfect bottom. She simply did the thing most people delay. She bought ownership while the crowd was craving certainty. So what are the rich buying while you are holding cash? And why does it keep widening the gap even when holding cash feels like the responsible choice? Here is the first truth. Cash is not evil. Cash is useful. You need cash to pay rent, buy groceries, handle emergencies, and sleep at night. Cash is the foundation of stability. The problem is that cash is not a long-term wealth-building tool. Cash is a short-term tool. If you keep too much of it for too long, you are not standing still. You are moving backward in real terms. Inflation slowly reduces purchasing power. It does not feel dramatic because it is quiet. It does not announce itself with an alarm. It just shows up as higher prices for the same life. If inflation averages 3%, that means money loses about 3% of its purchasing power each year. Some years are lower, some years are higher, and some places experience much higher inflation than others, but the principle is the same. Cash tends to decay. That is why wealthy people do not treat cash like a destination. They treat cash like a tool that helps them buy assets. And when you look closely, the rich keep buying the same categories of things over and over again, because these categories tend to do one job. They either produce cash flow or they benefit from growth in the economy over time. The first category is ownership in businesses. Public stocks are the most accessible version of that, but the concept is bigger than a ticker symbol. When you own a piece of a business, you own a claim on future profits. You own a claim on productivity. If the economy grows over time, well-run businesses tend to earn more over time. That is why, historically, broad stock markets have delivered strong long-term returns across many decades, even though the journey includes crashes, recessions, and painful years. The second category is real estate. Again, not just a nice home, but property as an asset. Real estate can generate rent. It can hold value when currency weakens. It can be improved. It can be financed. It is also imperfect and local and sometimes overpriced, but it has one advantage that cash does not. It is a real asset tied to real demand. Housing, land, logistics, and commercial space are part of how the economy functions. The third category is credit. When most people hear bonds, they think boring. Wealthy investors think differently. In periods of stress, yields often rise. Credit spreads widen. That can create opportunities for people who understand risk and can hold through volatility. Wealthy investors and institutions often buy debt, including corporate bonds or other lending exposures, because they can get paid for providing capital when others are scared. The fourth category is private deals and businesses. Some of the biggest wealth is built outside the public market. Private equity, acquiring small businesses, buying into partnerships, investing in cash flowing companies, acquiring distressed assets, financing operations. In downturns, many good businesses suffer not because they are broken, but because they are illiquid. When cash is scarce, terms become favorable for those who can provide it. The fifth category is optionality, and this is the one most people miss. The rich buy the ability to act. They build access to capital, relationships, credit lines, liquidity reserves, and long-time horizons. They do not hold cash because they are afraid of the market. They hold cash so they can buy when the market hands out discounts. This is why it feels like the rich always win. It is not that they never make mistakes, they do. It is that they are positioned to benefit from the way fear changes prices. Now we need to talk about the psychological trap that keeps people holding cash for too long. Most people believe they are waiting for a better opportunity. But what they are really waiting for is a better feeling. They want the world to look stable. They want the news to calm down. They want their friends to agree that it is safe. They want the risk to disappear. But markets do not pay you for investing when it feels safe. Markets pay you for taking risk when risk is priced cheaply and for staying invested through uncertainty. When the future looks perfectly clear, assets are often already expensive. There is a reason a famous investing principle exists: the idea of being fearful when others are greedy, and greedy when others are fearful. It sounds simple, but it is emotionally difficult. When the crowd panics, your body wants to freeze. When the crowd celebrates, your body wants to chase. And this leads to a pattern that destroys returns. In bull markets, people hold cash because prices feel high. In corrections, people hold cash because prices might go lower. In crashes, people hold cash because it feels like the world is ending. In recoveries, people hold cash because they missed the bottom and now they are waiting for a pullback. Then the next scare arrives and the cycle repeats. This is not a knowledge problem. It is a human problem. The brain treats losses as pain. We are wired to avoid pain. That is why holding cash feels responsible. It reduces the fear of immediate loss, but it can increase the risk of long-term decline in purchasing power and long-term missed compounding. Now for the math moment, because this is where the illusion breaks. Imagine you keep $10,000 in cash for 30 years. If inflation averages 3%, your purchasing power declines over time. Your account balance might stay at $10,000, but $10,000 buys less and less. Now compare that to owning productive assets. Over very long periods, broad equity markets have historically delivered higher nominal returns than inflation, even after accounting for major crashes. The exact number varies by country and time period, but in the United States, a commonly cited long-term average for broad stocks is around 10% nominal per year. Not every year and not in a straight line, but over many decades. $10,000 compounded at 10% for 30 years becomes about $174,000. $10,000 compounded at 3% becomes about $24,000. That is a difference of about $150,000, created mostly by time, not by genius. Now scale that up to a lifetime. Now scale it to a household. Now scale it to a family that keeps holding cash because it feels safe. The cost is not just money. The cost is choices. The cost is flexibility. The cost is the ability to handle shocks. The cost is retirement options. The cost is stress. At this point, someone will say, but the rich also hold cash. Yes, they do. The difference is how they hold it and why they hold it. For many households, cash is the plan. It is the default state. It is the final answer. They save, they pause, they wait. For wealthy households, cash is usually a small part of a bigger structure. They keep liquidity for resilience and for opportunity, but most of their net worth is tied to assets that can grow or pay. They want their money working, not sitting. There is also another layer that matters: access. Wealthy people often have better access to low-cost borrowing. They can finance real estate at favorable terms. They can borrow against assets. They can refinance. They can extend time. They can avoid forced selling. They can manage taxes with strategies that are not available to everyone. They can invest in private deals, funds, and opportunities that require high minimums. They can hire experts. So is the game unfair? Sometimes, yes, but that does not mean you are powerless. It means you need to understand the principles and apply what is realistic for your situation. Here is the principle in one sentence. The rich buy productive assets while others hold cash because productive assets compound over time and because fear creates discounts. Now, what can you do if you are not rich? You do not copy their size, you copy their structure. First, build a real emergency fund, not an imaginary one, not a credit card limit. Cash you can access quickly, enough to cover several months of core expenses depending on how stable your income is. The goal is simple. You want to avoid being forced to sell investments during a bad moment. Second, separate your money by purpose. Most people keep everything in one pile, and that creates confusion and fear. You need clarity. One portion for near-term stability. One portion for long-term growth. If you want, a smaller portion for opportunistic buying, but only after the first two are established. Third, automate long-term investing. The richest advantage is not prediction, it is consistency. If you invest periodically, you naturally buy more when prices are lower and less when prices are higher. You reduce the pressure of timing. You turn volatility into a process instead of a panic. Fourth, diversify. For most people, the simplest path to broad business ownership is diversified index funds, where you own small pieces of many companies. It is not exciting. It is not a flex. It is a machine designed to capture long-term growth without needing to guess winners. Real estate can be part of diversification too, but only if it fits your cash flow and does not trap you with payments you cannot handle. Fifth, stop confusing movement with danger. Volatility is normal. Prices move. That is the entry fee. Danger is not a red day in the market. Danger is being forced to sell because you have no buffer. Danger is high-interest debt. Danger is investing money you need next month. Danger is taking concentrated bets that can wipe you out. Sixth, build margin in your life. This is the real secret. The rich can buy in downturns because they have margin. They are not one surprise away from liquidation. If you want to act like the rich, the first step is not buying some exotic asset. The first step is reducing fixed expenses, avoiding lifestyle inflation, and increasing your resilience. In other words, make sure your life does not require perfect conditions to function. Now, we need to address the thing nobody wants to admit. Sometimes people hold cash not because they are cautious, but because they are protecting their identity. They want to be the person who never makes a mistake. They want to be the person who waited and then nailed the perfect entry. They want the story where they were right. But wealth is not built by being right once. Wealth is built by owning productive assets for a long time, through multiple cycles, while the world tries to scare you out of your position. This is why the rich appear patient. They are not just patient, they are structurally patient. Their money is placed in a way that makes waiting possible. So if you want the real lesson, it is not what specific stock to buy. It is not what house to buy. It is not what coin to buy. The real lesson is to stop treating cash as your main wealth plan and start treating it as a tool that supports your actual wealth plan. Cash is for survival and short-term needs. Assets are for growth. The rich separate those roles. Most people mix them and then wonder why they feel stuck. Here is the final idea to carry with you. If you are holding cash while waiting for the perfect moment, you are making a bet, even if it does not feel like one. You are betting that avoiding short-term discomfort is worth long-term loss in purchasing power and long-term missed compounding. The rich make a different bet. They bet on ownership. They bet on productivity. They bet on time. They accept discomfort now so they can buy freedom later. Wealth is not just what you earn. It is what you own. And the biggest shift you can make is to stop asking when it will feel safe and start building a system that keeps you investing even when it does not. This is educational content, not financial advice. Always consider your goals, timeline, and risk tolerance. And if needed, consult a qualified professional before making investment decisions.